webinars. Who's how many? We'll wait till the participant number is up and then we'll get going. That awkward point when you wish there was some less awkward music to play for this moment. Okay, we're gonna start, and people may slowly trickle in. We had quite a lot of people register, so let's just get going. So hi everyone. I don't know how many of you are VentureESG members, but I'm assuming a fair amount of you. So you probably need no introduction to me, but I'm Hannah. I'm one of the co-founders and co-directors of VentureESG. Brief intro, we're a non-profit organisation based in London, and we support a community of about 500 VC funds, about 100 or so LPs with ESG integration, and we host a lot of events and community calls and workshops and working groups and things like this to really surface all the key conversation points and topics of the moment, and this being one of them. I don't think anyone needs kind of telling that ESG has become a bit of a hot potato in the US. Every event we hold, we were in New York last week doing an event with WEF, and one of the main questions was, how is everyone feeling about ESG in North America? It comes up so often that we really wanted to make sure we surfaced it and brought all of the right people into the room to be able to speak to different perspectives, talking about how it's been politicized. I think it's, the rise of anti-ESG regulation in 22 states now, and whether or not that actually reflects what's happening on the ground and what's happening in reality. And what does this mean for VCs? Obviously on this call, how we're investing, how we're supporting our companies. So really that's what this call is all about. And I'm super excited to be joined by three brilliant panelists, all who come from different worlds within this ecosystem and can speak to different points of the debate. So we've got Max Meyer, who's Exec Director in JP Morgan Sustainable Solutions Group based in London. Then we have Karen McCormick, who is Chief Investment Officer at Beringea, which is a VC firm investing in Series A+ companies in the US and the UK. And she's also one of the co-founders and chairperson at ESG_VC, which is kind of a sister organization to ours, who support founders and portfolio companies with ESG. And then last but not least, Matthew Sekol, who is the Global Sustainability Advisor at Microsoft and sits on the LP Advisory Committee for Morgan Stanley's Next Level Fund, and has also recently published a book called The ESG Mindset. And he's also the author of one of my favorite ESG newsletters, which sounds incredibly nerdy, but everyone should subscribe to it who isn't subscribed to it already. So welcome the three of you. I think we wanted to start this call with a kind of stock take. So how are you all feeling about ESG in the US currently as it stands? Feel free to dive in.
I'm happy to go first. I feel like everybody right now, if you work in sustainability or ESG in the US, is kind of catching your breath. Like you can feel the weight of the election kind of in the hearts and minds of everybody who I talk to. And it's almost like, I don't want to use the word pause. I think breath is the right word. Everybody's kind of waiting to see what happens. That's just my quick take on what I've been seeing out there.
I continue to be positive, actually. I think we did a lot of work advising clients, both in the US and EMEA. And yes, there are some differences between the various regions, but ultimately, I am, when you look through the noise, you do see a continuing trend. So, I continue to be hopeful.
Yeah, I think from my own perspective, and I can speak more towards early stage companies than the large publicly listed funds. I think there's definitely a positive sentiment that still resonates across early stage companies, and that's both in Europe and the US. I don't think there's a huge difference in that sentiment. But I do feel that the ability to spend time, effort, money, resources, energy on ESG is cyclical. And I'd almost equate it to, if you think about a family or a household, if both parents or the breadwinner is well employed, making a lot of money, it's easy to make the decision that we're going to buy all organic, free range, better for the environment type products. If somebody loses their job and money gets really tight, you might revert back to every penny matters. We're just going to buy whatever chicken is available and the cheapest. And it's a somewhat bad analogy, but for a lot of people who manage funds, when the money's free flowing, when exits are prolific and great multiples are achieved everywhere, it's easier to say we're going to sacrifice a few basis points of margin to make better ESG related decisions. It's much harder when the market turns and every basis point matters. You kind of revert to just keep the lights on, don't worry about everything else. That said, I am definitely finding there are so many elements of ESG that are just now embedded in decision making. So an example is across our consumer portfolio, there isn't a single company that would go out and procure non-sustainable packaging. Like, it's just kind of the supply chain has changed and the decision making process has changed, that it's part of the decision making process. If we're going to send something out with packaging, we're looking for sustainable packaging providers. So that's kind of where I see it. It's harder to focus resources on ESG when the money isn't free flowing, but there's definitely still an embedded sentiment.
Yeah, and I think that's probably a good point that takes us on to the next question in terms of what have been the driving factors for the rise in negative sentiment in the US. Like, where is that really coming from? Maybe Matthew, over to you first.
Yeah, sure. I mean, I very much had a front row seat to this sitting in my office in Pennsylvania. And then I ended up writing about it in the book. And where I really saw it starting was with this misunderstanding about what ESG is. I mean, it gets conflated a lot with sustainability, with impact. And the way that it started with conservative states here in the US was really with this misinterpretation of it as divesting from fossil fuel investments, which is, of course, ridiculous because the banks that they were targeting are some of the largest investors in fossil fuels in the world. So this was not actually a thing that was happening. And observationally, ESG kind of became this really tight acronym to create a boogeyman to chase after for these states where, and this is the pragmatist in me coming out, these are actually material issues to the states. Like, Texas's largest export is fossil fuels. So if there's a perceived disruption as we go through an energy transition, of course, Texas is going to be upset. Now, on the other hand, here in the US, we have less disclosure regulation and more investment through the bipartisan infrastructure law, through the IRA. And over time, we've seen all sorts of different evolutions of this since maybe about 2 years ago. It's gone through phases where Congress has kind of investigated it. Currently, they're focused on proxy advisors. So if you're not familiar, publicly traded companies have all sorts of proxy resolutions that come up. Asset managers look to proxy advisors to advise on those proxy resolutions as well as governance issues. Those are a big target right now because there is also a misconception that they're kind of driving with values and not fiduciary duty. And where we kind of are today is right there. I don't know that the election is really going to necessarily change this move one way or the other, depending on largely how Congress plays out. But it just continues on. It's this really convenient boogeyman that has kind of come up, but I don't think it's necessarily true. We've seen even in Texas specifically, like, there is a blacklist of banks that the state is not. Now, it's not saying that private companies or private citizens can't work with these banks, but the state won't do business with banks where it is perceiving that they're divesting from fossil fuels, although many of those banks are in Europe, not all. And the state probably wouldn't be working with them anyway. So there's a lot, and we can go pretty far and deep. I mean, I just covered a whole bunch of different things, but yeah, I'd love to hear everybody else's thoughts or
Maybe just to chime in, I think you put it really, really well. I might copy you in that boogeyman termination. It's just true. I think and I'm sure this is a topic that we're gonna keep on touching on later on, Hannah. But I think it led everyone kept looking at ESG as like the big elephant in the room, and as like as a thing of evil, right? I think nobody likes to be prescribed what they have to do. I think, it should be, part of what you should do. And I think in the majority of investors, institutional and private, do integrate ESG as part of their investment process. And I think, what everybody has been doing as well, which they said they wouldn't, is to politicize the term. And so what's happening with a lot of, large public institutions in the US, that had, a very progressive DEI agenda, or, had, a very, forward-leaning and progressive, sustainability strategy, have now, basically toned down the narrative, just because, they don't want to be called out, singled out. There's a lot of DEI activism, ESG activism in the US, mostly led by, the conservative party there in the conservative states, and it's been used as a, as an instrument, to raise, not necessarily awareness, but to make them appear louder. But ultimately, and interestingly, I find, when you look at how much of, the anti-ESG movement is actually getting traction, it's actually not that much. As you look at anti-ESG legislation, a lot of it actually doesn't get passed. I think the vast majority doesn't get passed. The same with, anti-ESG proposals at, AGMs, general meetings. Again, that might get tabled, but they all getting voted down, apart from a very, very small percentage. So from where I'm sitting, and I think this is, very much what we, see in talking and dealing with our clients in the US, is that, yes, I think everybody just, keeps on doing their thing. They might not, put it, they might not publish, newsletters about it, to not to attract, that negative attention. But ultimately, I think they all continue to go in the right direction.
And like, how much do we think that, public markets and the ratings agencies are fairly responsible for this in terms of, sorry, Max, go.
Yeah, no, I wouldn't say like, I think the rating agencies have, less to do with, I mean, I think there's, again, we can have a whole webinar on ESG raters.
Please
and,
no.
I do think they do have, I have to say, I think they do have a valuable place, or there's a place for them, in the market, in the right context, and, knowing, understanding what they do and what they don't do. But I think the where I do see a bifurcation is institutional investor versus private, i.e., private equity, LPs, and venture capital. I think they have a very different approach to it, compared to institutional investors. So if we launch an IPO in the US, we would always prepare sustainability content, in the marketing materials, in the form of the analyst presentation or whatever it is, and when you engage with institutional investors. And sometimes the experience is you get to that section in the marketing document, and the investor says, look, I'm not interested. We can actually skip that entire chapter, which is fine. Whatever, we are just there to present a holistic story. If they don't want to hear about it, that's fine. I'm sure they take everything they need to be able to make their investment decisions. So that's the institutional side. On the private, on the PE side, if you actually look at the largest LPs, majority of them are US based, like CalSTRS, CalPERS, like the big pension funds. They have very pro ESG investment policies, right? They and private equity companies need them, and that's why there's a focus in the private equity industry on sustainability and ESG more broadly, because the LPs, the ones that they get the money from, do care about this topic. So they almost don't get an option to not care. And then additionally, on top of that, it is there's a huge opportunity to invest in companies in the so-called green economy, energy transition, climate change, climate adaptation, energy efficiency, right? Massive opportunities, from an infrastructure side of things, but also from products and services that are being created and innovated and invented. And so I think they try to capture that opportunity as well.
Yeah, I mean, lots of you who kind of focus on that same point, that it's it seems to be largely rhetoric, right? And the PitchBook sustainability survey that recently came out said that there's a big disconnect between what people say and what they do, in that people are still doing ESG, they're just not referring to it or saying they're doing it. So the term ESG and sustainability might have gone, but if you look at their actual day-to-day practices, they're still continuing. And obviously, this is the element on greenwashing. Is this generally what you're seeing? I mean, Karen, from your perspective, are you seeing that?
Yeah, I mean, I think I go back to that point about kind of, within our portfolio, the sustainable packaging is just the norm. I think that is built in. And I also feel that it's challenging for the industry as a whole to do itself great service under the banner of ESG. Environmental social governance is a huge, broad term that could cover so many different things. And anytime you've got a really wide-reaching terminology, it gets really hard to communicate and explain both what it is, the value, and the benefit. And I think some of the ESG backlash is that it's people still scratching their heads about, well, what does that actually mean? And what is your fund actually doing? Does it mean you're just going to step away from some controversial areas like fossil fuels, or does it mean you're proactively going to be investing in things that are making the world better? And that lack of real transparency and definition is what makes it in part challenging. So I don't think it's a bad thing. We're moving away from ESG as the terminology because it's just too far broad reaching. But I do think practices are becoming embedded. I would also suggest, I mean, on the negative side, it's no secret that ESG funds have not been as good returners, and some of them have been abysmal. And I still think there's a cost. There's a cost to sustainability, and there's a cost to ESG. And I don't think it helps us when people try to pretend otherwise. So another example, one of our portfolio companies, Monica Veneta, which is a jewelry company, uses all recycled gold and silver in their jewelry. There's a cost to that. So it does eat into margin. Being sustainable isn't necessarily commercially always the easier decision right now. And I think that is where some of the backlash is, that it has been portrayed as ESG kind of pays for itself. In some ways it can, but in a lot of ways it doesn't yet. And the drivers are going to be commercial. The drivers to shift into sustainable principles. I mean, as Max was saying, if CalPERS is only going to invest in your fund because you are doing certain things, you're going to do those certain things. If consumers or businesses are only buying your product because they believe in what you're doing, then that's a commercial reason to do it.
Yeah, I mean, we'll get onto this later around the drivers when it comes to fundraising, but I think you made a point, and Matthew, you made a point too, is this kind of reckoning and this correction, has it been a long time coming? Is it actually a good thing that we're now being forced to focus on the material issues and not really just talk about ESG as a catch-all giant bucket? So that's one question. And the second one, slightly related, is, whenever we talk about ESG and venture capital, we really try and separate it from the public markets. We say it's different, we're starting from scratch, we need to define it in a whole new way, articulate what we mean and what it means to early stage high growth companies, and not really talk about the ESG funds and poor performance in the public markets. How much can we really kind of try and draw a little barrier around what we're doing and kind of not isolate ourselves, but limit the impact of the public markets on venture? Sorry, that was two big questions in one.
Yeah, I'm happy to kick off. The breadth that you just spoke of and what Karen was talking about is part of what opens up ESG to attack, because it can mean you can morph it into meaning anything if you're going on the attack. So that's the first thing. From what you can learn from public markets, I don't know, it's tough right now because a lot of public companies are kind of all over the place. And I see it, like I think I even mentioned this last time we spoke. Like, I read CSR reports for fun because I like to see what companies are doing. And sometimes I will open up a CSR report and it is very apparent that the approach to what they're doing is philanthropy. And they're doing all these great initiatives that I applaud them for, but ultimately it's not core to their business. I think you find less cases of materiality in those CSR reports, but there's certainly pockets of public companies. Like Paramount just published their ESG report, and they talk about content for change, which is about adding diversity, not only in the content that they show, but also on the back end for the people who are working on set and the writers and things like that. And this has been something that they've been doing for a number of years. And to Karen's point, there is an investment that they have to make there. This is an investment in people that they need to make, and talent that they need to make, and content that they need to make, and advertising. It's definitely not a win-win situation. And I think that what Karen said is really, I think, a big takeaway from the public markets. Like, make it material, but also recognize that there's an investment that needs to be made there. This is not necessarily a near-term win-win, but hopefully in the long run, it does have some sort of either quantitative or qualitative benefit.
And maybe just to add to that, I think, maybe another distinction is, if we think about the evolution of, maybe this is more your European context, but hopefully can apply to the US as well. So over the years, right, the company started out with having a net zero ambition by 2050, and that was like the tick the box that the investors needed. But then the story moved on. Okay, then it was, what are you going to do for the next 30 years? And so then you had those interim targets put in place, and then the diligence around the targets started to become more and more pressing. Okay, how are you going to achieve all that? And then lastly is, okay, now you have all those targets. You told me about how you're going to achieve all this, but do you have skin in the game? I.e., is management incentivized to actually get behind those strategies? And what is this management team doing to achieve all that? So this is where we are in Europe for sure. I think in the US to a degree as well. But I think the next question is, and this goes back to what Karen mentioned. We are now in a macro environment where interest rates are high. They rose super fast. After 15 years of zero interest rates, all of those projects are very capital intensive, and the viability of those projects is just not there anymore, right? And I think this is then when investors need to reassess and figure out, okay, do I have the patience and the mandate from my asset owners to stay invested, or do I need to look for the capital to place it elsewhere? And I think in Europe, I think the capital seems to be a bit more patient. In the US, I guess it is not. And so now the question is, also from ESG focused investors is what you're doing actually profitable, right? Does it make sense? Like, what is the return profile of that investment? And I think that's a very valid question, right? It's especially for the asset owners. You're not just going to invest, and build a wind park, if you're going to lose money for the next 30 years. So, and I think this is where you come then back into what the role government needs to play, and policy. Like there needs to be a that gap needs to be filled. And to the other point that you made around is this ESG recession is another term I've heard recently. Is this a good thing? And I think it is. It's just a very different environment. 2021, 2022, at least the early quarters, where there was just crazy amounts of money lying around, and they needed to be deployed. So they poured money into everything, and with interest rates close to zero, at that time still, everything made just more sense. Now is a different environment. I think now there's more scrutiny, and I think now we need to also look at, do we have the capacity and the ability to finance all the technologies that are out there, or do we need to take a bit closer look as to, okay, which technologies actually are viable, which ones are most promising, and then for them to attract the capital they need to grow, right? Which means that some of the companies that have been created might not get the funding they need in order to survive.
I mean, it is interesting. I mean, both Max and Karen, you talked about this high interest rate environment, and that projects are capital intensive, and I guess it emphasizes the need for us to really prove the value of implementing ESG practices internally. And obviously we don't yet have the data, and even if we did have the data, I personally think it would be somewhat hard to demonstrate causation with a lot of this. But also, I'm wondering whether this then puts the emphasis on risk. Does ESG become more about risk again? Because if you look at in the last 3 weeks, there have been a lot of stories about ESG missteps in the private market. So, you've got Sorare, who have been taken to court for unlicensed gambling. You've got TikTok, it just got revealed that they've known about the mental health issues of their product for months or years. You've got Roblox, which is mainly used by kids under the age of 15, and shock horror, it's a hunting ground for pedophiles. Like, these are the things which aren't really, I mean, it is about value, because if you destroy that value immediately with one giant reputational issue, but that's a totally different conversation, right? It's not really about investment to avoid a risk in 5 years, 6 years time. I don't really know what my question is here. This tends to happen quite a lot. I'm a rambler. But how do we, in that environment, how do we reframe this from the company perspective? And maybe this comes back to your point, Karen, around, what's the business case for the companies themselves? Like, what are we saying to it? If it's not that consumers are going to buy your product because they don't actually care about this stuff anymore, they care about putting food on the table. Like, what does that business case look like?
Yeah, and I don't know that there is a great answer to that generally. And I think from our perspective at the early stage, and there is a difference between the public and private markets, in part because of the incentives and the patient capital. I think Max mentioned the patient capital. It doesn't even have to be long-term patient, but if you're thinking about, for public markets, CEOs and often board members and C-suite are incentivized on the share price, the near-term share price, at a minimum quarterly, if not even in shorter than that. And if you as a CEO come out and announce, we're going to go shift from, I'm using it again because it's just an easy example, from plastic packaging to sustainable packaging, which is going to eat into our gross margins by 0.25%. Your shareholders are going to vote with the share price immediately, and the backlash is immediate, assuming that most of them don't like that. And in lean times, they're more likely to not like that. Whereas if you're a private company CEO and you've got one or two institutional shareholders and you have a board conversation saying we want to make this shift, and everybody agrees, there's no immediate repercussion other than, your P&L is going to look a little bit different. You could try and argue, and it might be true, that, our customers are going to appreciate what we're doing. They're going to stick with us longer. They're going to buy more because we're doing the sustainable packaging and move away from other people. But the reality is, I don't think we see that happen. We do, but does it make up for the 0.25% loss in gross margin? Probably not right now. I think a lot of the return on that is the appreciation that we're working towards making sure that there's still, a company, a planet, energy, resources that we can be trading on in 5, 10, 20, 50 years. But I don't know that there is a paper business case for it right now.
Yeah, and I guess one of the ways to talk about it is, we have a working group on pre-IPO readiness. If you look at the exit opportunities, are we saying that the markets and M&A are pricing in these factors? How is that looking? Obviously, Shein you could say it's a good example. Maybe it's not a good example. I mean, who knows? But like, Max, from your perspective, given the work that you guys are doing on, on IPOs and M&As, how much are you seeing this be factored in?
I mean, I see it as quite simple, actually. So every business has ESG risks, right? And this is, I guess, to coming back to the question, a good place for an ESG rating, right? They, summarize those and quantify that, on a scale from, A to whatever the letter is and the respective methodology. But, I think it's two things. And this is the work that we do with every company that or JP Morgan gets engaged on and, we get involved with. Is step one is assessing, what are the ESG risks for that particular company or sub-industry, and how well does the company address those and mitigate those. And then part B is, working with our, industry teams on if there is a sustainability angle, like an upside story to tell, that, that finds its way into the equity story, right? To then educate investors or buyers around the potential upside. It doesn't make sense for every company. Not every company is, is at that stage where, you can actually craft something robust and credible. But yeah, there are enough stories out there, where you can do that. And it's then, distilling or, figuring out, who you want to sell this to, right? Is this a recycling story, or, and then you have so much more impact capital now being raised on the private equity side. There's a huge, amount of capital, that needs to be deployed that currently they don't have the opportunities to, put the money to work. So I think, there's always two sides to it, so yes, one is ESG risks. Every business has them. They need to be addressed, mitigated. And then on the other side, is the asset itself or the company itself, a good example of, an upside case. And yes, we do see examples where investors or buyers then, pay up for the right asset. But again,
Yeah, I
I
mean,
think it all goes back to the financials also need to be in place, right? To the whole, the double materiality, right? It's both sustainability and financial materiality, and both needs to be addressed. So you can't just have one or the other.
Yeah, I mean, not to play devil's advocate, but this conversation around like sustainability and impact is one that comes up, constantly in our conference. The other day, our GP panel basically turned into a conversation about climate impact. And, we try and always steer it back to talk about the ESG factors internally to every type of business, whether they're building SaaS or healthcare, digital health, or whatever it is. So I don't want to go down that impact route and how impact is priced in and pushing money into impact, because that's not, and I get what I'm interested in what you said is, you said the sustainability narrative is only interesting for some companies, but that's like not what we say to our companies. We say, someone building a SaaS compliance tool for enterprise clients, they go, oh, we don't need to care about ESG. And we say, actually, no, you do, because you're selling into a bank and insurance company who's going to ask you about this because they need to make sure all of their suppliers did, help with their net zero transition plans. So, but my point is, how would you approach it from a non-impact, non-sustainability company? Like if it was a pure tech company, would it not be an issue or not be factored?
Well, no, I think it very much depends on what the company is, right? I mean, I'm not saying there are companies that they don't have, there's no upside to it. But I think there are various degrees of alignment. Let's say what we always do is like we try to figure out what is what are the the major sustainability trends that this company benefits of, right? Are there then revenue drivers that lead to this company having larger growth than the peer set, or is it like the rest of our market is a larger one, the client set, etc., or is it is it the cost drivers, etc.? So I think it's more nuanced than that. I wasn't suggesting that there are companies where there just makes no I mean, oil and gas companies. Well, I guess that was oil and gas companies. You could argue like what is what is the actual sustainability upside here, unless that we're transitioning from fossil fuel to wind. But I think the point I was trying to make is that it needs to be credible, and this around this whole agenda to not be able to already to open yourself up to attack. It needs to be well crafted. It needs to be well thought through. It needs to be robust. It needs to be backed up by data. Right? You need to be able to support the argument you're trying to make by financial metrics ultimately, or other KPIs that the business is tracking.
Just to go back a bit to the fund level and fund motivations, our community is 70-ish% UK European funds who obviously having to adhere to SFDR or soon to be SDR, and lots of the US funds who are part of our membership are also wanting to raise from European LPs and are being forced to think about that as well. If we take that away, there isn't an SFDR, SDR equivalent in the US, and it doesn't look like there will be imminently. So Karen, I guess from what you're seeing from your US peers on this topic, are they kind of doing ESG and not talking about it, or are they actually pulling back from it? How can we, as we kind of go into the US and spend more time there with VC funds, how should we be thinking about the landscape and in the context of what's happening in the public markets?
I mean, I would say from our perspective in terms of private fundraising, I do notice we probably get fewer questions from US LPs than we do from European LPs about ESG. I haven't had any actual backlash. Anyone, suggesting that they didn't like it or wouldn't be investing if we had an ESG or sustainability bent or focus, but there are fewer questions. I think outside of that, for us, I almost think the founder drive is more impactful than the LP determination. I think limited partners, and just for clarity, limited partners are people who would invest in our funds, for example. So the people that we as a fund answer to because they're the ultimate investor. I think what has become more important for LPs generally, both US and UK, is the ability to report against it. Everybody loves the idea that we can produce reports explaining what we're doing and what our portfolio is doing. How much they care about the impact versus the report is questionable at times. Sometimes they really care. Sometimes they just want to be able to hand something over. But the place where I think that the real impetus is coming from is founders and consumers. And I can give a recent example of a business that we looked at. Great founding team, really, really liked the business. It turned out to be an incredibly competitive deal. One of the decisions that the founders had made was that for every transaction that they completed, they were spending money on effectively sustainable activities. And it was effectively a charitable commitment in a way that said, for every transaction, we're going to do X. Our view as an investor was we support that. We love it. It makes a lot of sense. What happens if this business turns south and every penny counts and we're going to go bust? Are you going to keep doing that? Like, will you keep sacrificing that margin, or would you go back to saying, you know what, we'll stop that activity until we can afford it again? The founder's view was we are not stopping that activity. That's a commitment that we're making. We're doing that. If you want in on our business, you need to be supportive of that. And it's going to be written into the legals. And from our perspective, we love the business enough and we believed in the business enough to say, okay, that's something we can get comfortable and get our heads around. And I think it was a very competitive deal in the market just because it's a great business. And if you're a founder who has a great, highly competitive business, you can dictate that. If your business is okay or you don't have competitive bids or whatever, it might be more difficult. But the more founders who are running phenomenal businesses who just say, this is an embedded part of our business, the more it just becomes the norm. And then for the next business we look at, that's not a sacrifice in margin, it's just the norm.
Yeah. Matthew, you look like you were going to say something, but maybe
No, I was just going to completely agree with Karen. I mean, the same thing. I mostly, even though I sit on an advisory committee for an investment firm, and Karen, I am the one who is always asking the ESG questions in the room. If I'm sure you can believe that. But the same thing happens with public companies. I mean, this is why, to Max's point, we're seeing a massive pullback in DE&I because in the slightest reputational risk against DE&I, companies are folding their programs up. And I've written about this before, Hannah. Like, it largely has to do with those DE&I programs were not material to the business. They were trying to go after the systemic issue in a bubble, which I applaud these companies for trying that. But as soon as they get a pushback, it's gone because it wasn't material. If it was material, they would go back to those people and say, no, this matters to our business. We're going to keep doing it. Or they take the stance that Karen's founder did and say, no, this is important to us. We're going to do it. Yeah,
and actually that's okay. Like, because they should be spending their time and effort on things that are material, not things that are just box ticky. I mean, it would be a failure of this webinar if we didn't ask the question about the election. Kind of Matthew, you said we're in a holding pattern right now, or implied that. But you know, looking at kind of after November, what could happen? And you know, I think about what impact that could have depending on the way it goes in terms of where founders raise money from, where funds want to raise money from, where companies want to expand to. Like, it could have a whole kind of range of implications. How are you guys collectively or independently thinking about it with your different hats on?
Yeah, I'd say I'd advise not to get distracted and keep an eye on your business. And I'll give you an example. I'm sure many of the founders on this call are leveraging artificial intelligence because that is the trend right now to capture. Artificial intelligence has three intersections with ESG at least. One is if you're a supplier in the supply chain, the disclosures make it material for you to have to report the environmental impact of your algorithm to somebody. They're going to ask the question at a minimum. The second thing is social. We hear about bias. We hear, especially like if you're running a healthcare AI algorithm, there are definitely social intersections with AI that need to be considered. And the third thing is governance. Your technologists, if you're not a technologist, will tell you, they will say the word governance to you when they're talking about their data, when they're talking about the algorithm. And having that strong governance model is the only way you're going to, it's one of the ways that will help ensure that you won't have to roll your algorithms back at the end. So like if you think about ESG in that material lens through something like AI, which you're probably using, that's how you should focus on it. Regardless of whatever happens with the election, these things are still going to have to be addressed in the same way that you would regardless of who's in the White House.
Okay. Max, Karen, anything to add? If not, we might go into Q&A.
I'd agree with what Matthew said. I mean, ultimately, I think the big question is more around the IRA. I think that's a question that we ask ourselves, and that's a question we get a lot from clients. I guess the jury is still out. I mean, this is I guess we will not know what happens, especially if Trump enters the White House. There's a lot of talk around how difficult it will be to dismantle IRA, because it was specifically put into the states that to the Republican states. So, but yeah, I think we will only know whenever we have certainty on who is in the White House.
We intentionally, well, yeah, you might have wondered why I didn't talk about IRA. For us, that feels like it's something that really falls into climate investing and the climate impact businesses, and it is obviously part and parcel of ESG, but not core to how we define ESG. I guess when I was asking that question, it was more from the fact that there's a lot of regulation coming out of Europe across a number of different areas, and if Trump gets into power, does the US become slightly more attractive from a company perspective, in that there's less regulation to adhere to?
Good question.
I'm also happy just to put that out there as a.
No, I think it's it's a very valid question. I mean, we always the debate then very quickly then comes into data and how useful is data, and does it actually drown innovation, and or is it helpful because it provides comparability to then channel investment and money towards the technologies that that make more sense than others, for example. So I guess this is obviously part of why Europe is leading in that space, if you can say so, because a lot of it is directed by regulation. At the same time, those teams, the question of, okay, where should those teams sit? They all need to scale up in terms of responsibility, knowledge, and experience, and so on. But yeah, I don't have the answer necessarily. Is the US going to be a more a better place going forward because people flee the regulation, or is regulation helpful in order to channel funds, and because you have that comparability and it's more ingrained and embedded into everything that every company does?
I won't comment. Don't want to reveal biases on this call. Karen, do you have anything to add, or we can go to Q&A?
Yeah, I don't have a lot of insightful things to add. I would just suggest that this isn't the first arena in which the US has had a looser regulatory environment than Europe, but European companies still exist, right? So might somebody come here? Yeah, maybe. But is it going to be a flood of businesses leaving Europe to get to the US for? I don't think so. And I actually think the economic cycles have a bigger impact on when people are willing to take the hit to spend on ESG related initiatives than necessarily the government regimes.
Yeah, if I could just add, there's been some interesting articles lately about the new exchange that's launching in Texas specifically, and rumors of companies leaving Europe to go to the Texas exchange, which I find extremely hard to believe due to that reason, lack of regulation. But I think there's a lot of factors to consider in moving to the US, depending if Trump wins or not, including the amount of uncertainty. And I've heard some financial services firms talk about that. It could lead to a highly unstable environment over here to operate, regardless of the low regulations,
Yes.
because you just don't ever know what's going to happen.
Yeah, you can't look at it just from one dimension, right?
Right.
Yeah. We have had a few questions, but if anyone has any questions, please do put them in the chat now. We've had a comment. I'll read a comment. That sounds like something I would write. I think the issue is that all of these risks are a probability risk. It may happen and impact investment during your investment hold, but it also may not and deliver great returns. I think that sounds similar to something that we all said. One from Jeff Trotter for Matthew, which you've answered, but maybe you can answer out loud. Could Matthew provide an example of a sector where DE&I is not material?
Yeah, I think it wasn't that I was saying DE&I isn't material. It's that the programs that were stood up were largely in response to George Floyd's murder in the US. And I've heard this from people who have stood up those programs. And as a result of reacting to the crisis, and by the way, this is not all DE&I programs. Like I mentioned, Content for Change from Paramount. That is a material DE&I program. But a lot of companies have stood up these programs and they're just not material to the business. And so when people like Robbie Starbuck, who is a conservative personality, comes and starts pushing on these programs, the company is like, these don't matter to our business. And in the slightest breeze of a reputational risk, I'm going to shut these programs down. I am not saying, by the way, to shut down DE&I programs. I am saying, understand your business, understand the intersection with DE&I, and then build programs that will last. And that's exactly what I write in my book too, because there are too many DE&I programs shutting down because they are not material, and it's harming the entire movement of anybody doing anything with DE&I, because all people hear are DE&I programs people are backing away from DE&I, and that's not the case. It is these programs that are not material that they're backing away from on the back of this reputational risk that is perceived.
Second question, who can or will push for more and better ESG integration in the US VC? Do we need more LPs to ask? And perhaps Karen to start.
Yeah, I think it probably does come back to customers, founders, and LPs to some extent, but I almost think it's going to be driven more by founder mentality. Because if a founder isn't interested, you're not going to be able to force them into it, really. If a founder is interested, like that's the DNA of the company. And then consumers rewarding businesses for doing it. Legislation, it can make a difference. And I think we can see it in Europe. The legislation coming down the pipe, people are trying to get ahead of. So it is helpful. But I still see at our end of the spectrum, less driven by LPs, unless you are specifically an ESG or sustainability fund.
What does that mean in ESG or sustainability fund in the context of venture capital? Because we typically say there's no such thing as an ESG fund. We say every fund should integrate ESG and by that definition be an ESG fund. But what do you mean?
I'm talking about funds that market themselves as purpose-driven or impact funds who are willing to sacrifice margin and say they're going to sacrifice margin for some type of impact. But I think the question is really valid because I don't know how to answer that. There are a lot of people marketing themselves that way, and some have kind of a clear definition of what that means they're going to do. But for a lot of them, it's just kind of we're going to exclude certain industries.
I guess we always talk about, the kingmakers, like these LPs have put money into Sequoia and Andreessen for years and years, decades, and they're not asking ESG questions of those types of funds to the extent that they are of emerging funds. So how can we look to LPs to really drive some of this engagement when they're making those investment decisions and choosing?
If you think about though, for a limited partner, for most of them, like if you just think about CalPERS, or you think about a pension fund, which is a huge amount of money, capital that goes into the funds, they need to be able to create pensions for their shareholders. Like that has to be the first reason that they're in business. if their shareholders run out of money during their old age, like that's not something they can compromise on. So they need to be able to deliver that. So it's always going to be paramount that they're making the returns they need. And I go back to, like, for me, it does keep coming back to economic cycles. If you're making money cast over or hand over fist, you can afford to say we're going to compromise on margin here for the good of the world, the people, etc. So
But it's
I
not
mean,
just compromising. It's not just compromising on margin, right? It's actually building slightly unethical businesses in some instances. So
it can be, and
it's
I think it's a lot easier to say we're just not going to invest in, for example, gambling or tobacco, or maybe fossil fuels. It's easier to do that than to say we're going to actually go make a positive impact by investing in an impact fund or a purpose-driven fund.
Yeah, I think the mentality of grow fast, break things still very much prevails, and that isn't compatible. So I think if we're banking on West Coast founders to start engaging on this and not want to cut corners, then we might be waiting a long time. But let's see. Maybe not with ESG_VC and VentureESG at the helm. Maybe we'll change some of that. A question from Edward Dixon. In financial services, impact is very much the zeitgeist, and I think we're seeing it become a lot more mainstream. Do you think LPs are leaving ESG behind or accepting that it generally gets done and they're now setting their sights on impact? If yes, do you think the market is responding with the products and queue of investable assets needed? Anyone can take that.
I'd love to hear Max's thoughts, but I think I'm seeing this way more in the EU than I am in the US. While I don't think companies in the US are leaning towards impact more. The big companies, like I work at Microsoft, focused on impact. Not many of them are, though. They're not focused on ESG either.
Yeah, I think it's more to figure out where you can have, well, again, it goes back to the question of, is it credible, and who are you trying to sell to? So I think when we talk to clients, I think Matthew mentioned that as well. The terminology all gets meddled together, like ESG, sustainability, impact, and they're all very, very different, all very different things. We see some of the clients we work with trying to create an impact narrative, and I think that is in addition to them having sorted out their sustainability operationally and everything that touches that, just because there is, especially in Europe, such a big rise in especially impact funds, right? And then it's more like how can you align yourself in a credible way, again, supported by data, KPI, and things like that, so you can back it up, that you can then talk to those funds to be appealing to them, and eventually, if everything works out, get acquired. So I don't think necessarily that there is a big move towards that. I don't necessarily see a shift. It's more like the advisors then think about the broader applications. Okay, is this can we craft a credible narrative here? But it's certainly on the agenda. So we would always talk to them about it and to make sure they're aware, because I don't think many many founders and necessarily see themselves being a target for an impact fund per se.
Cecile from Batango has asked, you're all saying that the business imperatives need to be linked with ESG impact principles. In other words, make ESG impact a good business opportunity, which makes perfect sense. How do you propose to change the discourse about ESG impact so that businesses and founders understand it this way and not as a sort of burden ESG for ESG's sake, which is something that we've touched on a few times in this conversation, but I guess she's going to the very heart of it.
I mean, maybe one thing I'd say is, I think sustainability or ESG is a great tool, for value creation. Yeah. Again, so if you think about from the way you run a company, if you don't treat your employees well, they will leave. You're going to have to constantly hire. That becomes a business risk, right? And will also then show in profitability, severance packages. You just don't have a continuation. The same with your suppliers. You don't have robust procurement policies in place, or supply chain processes in place, then you're not going to be able to fulfill the products and services that you're set to sell. So I think that is, I think the easiest way for me to explain, the value of sustainability, or understanding, integrating ESG into the way a business operates. Because good sustainability, integration into the business, then should equal superior outcomes and superior business performance, which then results in superior financial performance.
One last question, and I think we'll wrap up. From Ian Sinclair, from a risk perspective, the Chinese market often takes a strong regulatory position, occasionally in hindsight, particularly the 3 red lines towards construction. Given that ESG regulation has impacts along the value chain, can you see a future where Chinese ESG regulation has a global impact? What a question to end on.
That is a loaded question.
I mean, it's almost the hour. There's no obligation to answer any questions.
I've seen, there was a really interesting article in the Financial Times a couple of weeks ago about progress in China, especially around artificial intelligence, but also around sustainability. And while their carbon emissions have gone up because they're trying to support their middle class, it requires a lot of power. They have to get, dirty power to do it. They're apparently really trying to move the needle forward and innovate along both artificial intelligence and sustainability in a way that I think is less about the regulation and more about it will create competitive pressure outside of China to compete. So that's my quickest take I could possibly have on that topic.
Well, on that note, we can end there, and a huge thank you to you 3 for joining and getting involved in the debate, one which I hope has answered a few of people's questions. But thank you so much, and thank you to the folks for joining this call. And I would say have a good day, but it's the afternoon in the UK, so have a good evening. But wherever you are, have a good day, a good evening, and we'll speak to you all soon.
Thank you.